Good morning, everyone, and happy Monday. Welcome back to the work week, start of the last quarter. And you know what we have for you? We have Brendan McCarty back with us as well to kick off the work week. Brendan, welcome back.
Hey, good morning to you.
Now, obviously, we could be sitting here talking about Tesla missing estimates. We could be talking about Kim Kardashian getting charged by the SEC. But no, we're going to come here and give you all the exciting things from the week. The show's brought to you the wonderful team at Open Exchange. Look to them for all of your virtual event needs. Now, today we have the Fed emergency meeting, 11:30. It's the big news that everyone should be focused on. What could this be about? Is there a pivot coming? Is there a big bank going to be in trouble? There was speculation over the weekend about Credit Suisse, but remember that the CEO spoke to employees last week and confirming that they have solid capital and liquidity. So maybe it's going back onto, let's focus on, are we going to be halting the rate increases or not? I don't know. Brendan, what do you think this meeting's going to be all about?
So on Friday, when I first saw the headline, I was like, ooh, something big is going to happen. Let's save Lehman Brothers over the weekend sort of thing. And then, first thing comes out, well, this was sort of a regularly scheduled meeting. I guess they have these closed doors meetings all the time. But the market also sunk into month end. I mean, it was the S&P hit 3,600, broke through support. The world was coming to an end. Everybody was panicking. CS's stock was sinking. Still probably is, I think, this morning. I think this meeting is more about getting one's ducks in a row. I think it specifically says something about policy. I don't think the U.S. markets are having any real trouble yet. I know that a lot of people are citing the MOVE index and the Treasury market, but the way I look at the Treasury market is this: it's been rallying for 30 years, 40 years. We peaked in 1980. It dropped to low in 2020. You're looking at a 40-year bull market unwinding. Well, you know what? If that unwinds, the MOVE index is going to climb. So that's my response to that. For CS, Swiss Central Bank surprised everybody like a couple months ago and raised rates. Not a single person seemed to know about it, even its own currency. I'm guessing Credit Suisse and UBS both felt the pain on that. That was probably a first blow that happened to them. The second thing was the UK pension issues 2 weeks ago. They're all using these insurance products, which sounded like exchange. God, I forget what the products were back in the day. But during the global financial crisis, we had all sorts of stupid products out there being sold to people, and they were illiquid at times. Well, these insurance things probably didn't help when the gilt markets went to the moon. So that is also on the docket. So I'm guessing the Fed, Powell and his crew said, all right, go out to your districts, find out what's going on, check with your banks. If there's an issue, let's talk about it on Monday. That's how I'd run the Fed. Not that I'm running the Fed, but that's how I would manage a crisis. The U.S. doesn't have, the U.S. markets have come off higher. The S&P was 4,700 a year ago, and we're at 3,600. So that's a decent decline. But this is the problem is, should the S&P have always been this high to start with, given that we had a pandemic? So all we're doing is unwinding all the excesses. Has that caused a problem in the U.S.? I guess we won't know until they meet. The way I look at this is, if the Fed says nothing, that's a good thing. We don't want them to say anything. If they come out and say there's something wrong, that means something broke. And then that takes us to that 2007 comparison that I've been drawing over the last week. Was the UK issues the shot across the bow, just like Bear Stearns and its funds blew up in the fall of 2007. And then I got the front row seat to when I was there. The Fed stopped and pivoted on policy in 2007 based on that and other things, of course. If they were to do the same thing right now, there's probably a bigger issue in the system. If they come out and say, well, we're going to stay vigilant to policy, they might cut it down to 50 basis points next quarter, next meeting. That will all come in. But I think if they announce something's broken, that's worse for the markets than saying, all right, if we may hit the status quo, that might actually be good for the markets. So I don't know what's going to come of it. CS belongs to the Swiss National Bank, doesn't belong to the United States. They do have a footprint here, but I don't know. It's not that consequential, I don't believe.
Well, let's put a little bit of a conspiracy theory into this one now. Envision this. Credit Suisse is really in trouble, and they've gone and spoken to the banks. Let's say the Fed has caught on to this and okay, here's an opportunity for us after we've worked out that we've raised rates too quickly, now that we can say, listen, because of this, it gives us an opportunity to put money back in the market, shore things up, and so forth. You think that could potentially happen?
Well, I'm unsure. Powell is a market guy, more so than any Fed governor we've had. I don't think Greenspan was a Fed market guy. Volcker, I'm not sure what he was. But so Powell's goal, what noticeable, the last meeting when Powell was speaking, after he said data dependent, the equity markets went straight to the moon, and he hesitated. And he said all of a sudden, let me repeat what I said in August. So obviously he was responding to the equity markets at the time. I don't think he cares about the equity markets going up. That's my bottom line here. And I don't think they would inject money in the system. I firmly, money is the problem right now with inflation. They need to suck this stuff out of this. There's simply too much of it sitting in the system. You can shut off demand for periods of time, but when demand turns back on, the money's still there. So yes, they could use CS as a reason to pull back and say, let's pause, let's take a break, let's see how this factors through. I don't know. It's a tough one. I don't think they're going to touch quantitative tightening. I think they leave that alone. Maybe on rates, they should slow down. I mean, they've gone awfully fast and they're awfully tight. So it might be a good idea. They may take this as cover to slow the rate hikes. But if they see the stock markets rally, I think they do an about face. I don't think they want to see the markets rally. I think they believe wealth creation is part of the problem here. And wealth creation is helping inflation. And if you have too much demand against a lot of money, you have inflation. So that's what I think. I don't think Powell wants to go down as the guy who created an inflation spike, which he did.
Well, that leads in very nicely into our next question here. We have a viewer question from one of our viewers, Sam M. in London. And I quote from him, first-time buyers in the UK are totally screwed at the moment. Property prices are ridiculously high, as are interest rates for mortgages. There are a lot of youngish first-time buyers that have a deposit and could get a mortgage, but cannot afford the monthly payments for the mortgage that the bank would throw at them. Therefore, there could be a lot of people who are just sitting on a large amount of money that they have worked hard to save for, or inherited, more likely, that is not working hard for them, wondering where these people should be putting their money. This is not unique just to London, Brendan. The same can be said for here in the US and many other parts of the world. There is fear in the market that we've talked about for many months now, and fears of 2008 are definitely entering people's minds. Brendan, is cash the best option right now for Sam M? Or do you think there are better options for them to be in the market?
So this is putting my financial planning hat on now. So anyway, no, the way I look at this is 4% T-bills are appealing when the market's in a downtrend. You don't want to lose money, right? 4% T-bills are not appealing when inflation's running at 8%. So what's your better of two evils here? You want to lose less money, or you want to lose more money? I would say T-bills, if you're in the US, is the best option. I can't speak for the UK market. I don't know what the gilt market looks like, but the way I look at real estate is this feels like '05 to me in some regard. First thing that falls is real estate prices, which we're finally starting to see. So if you're renting, you're going to feel the pinch of the rent still. The rents are still insane everywhere. So you're still going to feel that pain. But when you're buying a house, that your plan, it becomes more like, it's not like a 30-year plan for your assets. It's a 1 to 2 year time horizon. I went through this. I remember buying a house when we bought our first house. Really, we had a condo before, but '05 it was really hard to find a house, and everything was shooting up, and everything. It was like, how that we have all this cash sitting. What can we do with it? And we waited and we waited and waited. And I would just say that the way this cycle I think will work is rents will hold high, but real estate will come off. We've had mortgage rates essentially double. So mortgage payments have essentially doubled, which basically means real estate should come off by 20 or 30% in some cases, just in some markets that are insanely priced. So as prices fall, this will push people away from rental units into residential market. So rents will drop while you're waiting, which puts down, then the stress will actually hit the landlords, which will put more stress on the rents. So long story short, I know the pain hurts right now, but I would sit in the shortest duration asset you have that's earning interest. It's better than losing money in the markets. A house purchase is not a 30-year plan. It's a 1 to 2 year type thing. So if you're buying a house in 1 to 2 years, well, you're not exactly going into the equity markets to build up that kitty anymore. You're putting it under the pillow, or you're putting it in something that's ready to be deployed. So yes, if you can't afford the payment right now, you shouldn't be buying the house. That's the first thing. But the second thing is, sit it in a cat. There's interest rates are rising everywhere. Like if you're in the UK, the Bank of England's raising rates. I wouldn't recommend being in the 30-year gilts that sort of upended their whole market over there. But you stay in a short duration asset there that earns you 1, 2, 3%. Inflation will back off. I think it is. The conditions for it are sort of setting up there. I don't know about the UK because they just injected too much cash. But I would just sit in a short duration bill, wait for these markets to back off. Don't ever buy into something you can't afford. And don't put it under the pillow. But if it makes you feel better, put it under the pillow and have it earn interest in the process.
All right. Well, Sam M, I hope that answers your question. Moving on, images from Hurricane Ian are still fresh in everyone's mind. Our thoughts and prayers with the people that have lost loved ones during this time. The cleanup and rebuild has begun, and it could be a long process from the images that we have seen. From a stock perspective, it is well publicised the impact on insurance companies. But let's dig into the travel and leisure sector names. I want to look at Airbnb, Expedia, and hotels, Brendan. We're into the fall now, and winter is around the corner. That's tourist season for Florida. So which of these names is going to be impacted the most?
So hurricanes have always intrigued me. You watch the map and you watch where they go. And I had a wonderful app that I just could not find this weekend. So I wanted to see what the hurricane season looked like. But anyhow, I would just say I found some interesting facts about these hurricanes and how it relates to these stocks. First, according to New York Times, in the counties that are hit the hardest by Ian, only something like 20% had flood insurance, which is incredible. So if you're an Airbnb owner, you get to keep your, according to their terms of service, if you really want to force this, you could actually keep the fee that these people pay, even though you don't have a house anymore. They probably got wiped out by the flood. Of course, one payment's not going to change anything. Well, maybe it would. I don't know. But the only way to fix these for the Airbnb folks is to get a FEMA grant, an SBA loan, which you call yourself a small business. That's a gray area. Or you dip into your own wallet to repair it. I remember when the pandemic hit on Airbnb, I thought those rental owners were all going to sink. And I know that there was mortgage relief from the government on those sort of things, which delayed that. That doesn't exist anymore. If you're an Airbnb owner and you're heavily levered, you're going to walk away. I would guess you walk away. So that changes the supply and demand dynamics down there for the rest of Florida that didn't get hit by Hurricane Ian. Like we were talking about before, rates for this stuff's all going to go up. I mean, it's just one vacation place. I know this is the point where a lot of people start heading down. It's like after Columbus Day or into November. For travel in general, the funny thing is, though, I've been looking at the charts of Marriott, Expedia, CCL as well, because we'll talk about it a little bit. They, in 2007, they all weakened in the same way they're weakening now, which is kind of strange. I wasn't actually thinking about 07 from a market perspective until I saw the charts of these three. They have all weakened in a very similar shape. In 07, the consumer was weakening under the weight of falling real estate. I don't know what there were hurricanes back then, but I think there's bigger cycles at work here for these names than this destruction in Florida. Usually it's more than one hurricane that really creates these issues down there too. It's like the over and over impact. Florida always seems to bounce back stronger on these things too. It's like these trucks all line up on the border and wait for these houses to be knocked down so they can rebuild them. It's amazing how quickly they fix things down there. Granted, you can't fix the loss of life, so that's a sad part. But I would say that I think there are bigger factors at work than just Florida for these names. And I wonder what next year actually looks for them. If the consumer actually is rolling over right now, Florida will be minor compared to what is happening in the grander economy. Airbnb is very fascinating to me in that if 80% of these people, like the 20 who had flood insurance, let's just say 50% is Airbnbs, that means 40% of Airbnb holders didn't have flood insurance. Well, if they're all flooded out, they're not renting their places for a while. It's not like you can walk in there with a mop and a broom and, soak it all up. It's going to take a while. People can't even get to certain areas down there. So it's really hard for Airbnb. But Airbnb survived the pandemic. I never thought they would. So I'm guessing Florida will be a minor hiccup. I think the grander picture is where are we in the cycle? And that's what's going to ultimately determine what's going to happen next. So I think Florida will be minor. I think like you said, inflation and rents and stuff down there is going to skyrocket for who's left. If you own an Airbnb, you just got a 25% bump in your fees. Though I'm guessing you already rented it out, so you won't feel that as much. But a hotel can pivot more quickly. They can raise all theirs. Expedia will benefit for higher fees. But I think it's just Florida. It's just one place. If the whole country is hit by a hurricane, you could have a different story. But I think there's a bigger picture playing out here for these names than just Florida.
Okay, well, sticking with the theme of Florida, let's look at the cruise lines. Friday, Carnival shares hit their lowest level since 1993, following a disappointing update on Q4 bookings that also rattled the shares of Royal Caribbean. Norwegian Cruise Lines holds an investor and analyst event on Thursday this week relating to business and financial results, and could be a share price move, I should say, for all of these three stocks. Brendan, do we just steer clear of the cruise lines, or is there an opportunity to jump in on these levels?
So the cruise lines are fascinating in what the analyst community looks at it versus what I think of them, which is no surprise. Analyst community thinks getting more people on these boats is a great thing. So I think we talked about these two names about 3 months ago, if I'm not mistaken.
Yeah.
Carnival has a lower profit margin. That's their thing. They want to get more people on. Norwegian has a smaller fleet, but they have higher margins. So my overlying theme during this inflationary environment was, if you have higher margins, you can absorb the issues from these inflationary pressures. If you have lower margins, you cannot. And that's what's happened to Carnival. That chart looks horrendous. Carnival's chart is horrendous. But Carnival's problems, we've been saying it since they became a meme stock, or then stopped being a meme stock. That is, they have too much debt. They don't generate enough revenue. I know they're back to pre-pandemic levels, but they don't have enough income either to service the debt. I mean, they're not a zombie company like we featured a couple of weeks ago, but I mean, Carnival's not a disaster, but the chart looks like it. Now you flip over to Norwegian, they have margins to sort of pay off the debt. They're not issuing a dividend because they have covenants to pay off the debt. They're more responsible, it seems, and they have a higher clientele. Now, interestingly enough, they've moved away from more expensive boats to cheaper boats. I didn't know that until recently. I'm not even sure if it matters to some extent. It's all about debt with these names. Cost of debt's going higher. I didn't even think to look at this, but if these companies have a refinance coming up for their debt, they're going to be doing it at a much higher level. And when you're a triple C rated company or a triple BBB minus, or you're a junk rated company, your cost of debt goes up much more quickly than others. So I think that's what's affecting everybody. Now, CCL's report wasn't entirely bad. It actually showed good demand. So if Norwegian can take the good demand part, maintain its margins, it actually might be an interesting story. I wouldn't buy any of these names other than I would take a shot at Norwegian, maybe at $11. It's sitting right at support. It has to bounce from here though, and I wonder if they priced in all the bad issues from Carnival. So Norwegian probably the one I would take a shot at. The others I'm not super excited about.
Okay, well, two little extra add-ons, or maybe one extra add-on. If Carnival is in a situation where they are, and like obviously they must be getting closer, because I think just after COVID started, they did a big debt issue.
Yeah,
if they are getting back to that point where they need to do it again, and they can't, is consolidation in the sector on the cards?
I don't know. I guess when airlines go out of business, do people buy them? No, they just let them die. I wonder if the Norwegian and Royal just swoop in and take their business and then buy. I mean, I guess then they buy the boats. So I guess you could see some consolidation, but it is an oligopoly of what, 3 names really?
Yeah, well,
only 3 players.
Private equity get involved too.
Yeah, the boats have value themselves, and if you could rid yourselves of all the debt, maybe bankruptcy is the goal. Maybe they bankrupt then they have the boat seized. That's a tough one. I'm not entirely sure. I would just say that cruise line, the demand is there. It's just they're not making enough money on it. So if your demand is there because prices are lower, then, well, you're giving it away. If demand is there because demand is like regularly, it's real, and it's organic, and it's not based on price, then you have room to raise prices, which gives you a more solid balance sheet. So I would just say, I don't know what an oligopoly would happen to do. I remember studying this stuff when I was in college, but I don't know what an oligopoly would do. They're like a club, right? So they help each other in a way. But debt is a problem. If the rate markets continue to climb, refinancing their debt is not going to be the easiest thing in the world.
Okay, let's go on to the earnings side of it. It's a very, very quiet week for earnings, but we've managed to pick out a few names for everyone. Conagra report on Thursday pre-market, and their share price has been a roller coaster ride this year, bouncing between $30 and $37. But all in, being down 4.5% year to date is an impressive performance. They've been making all the right moves, but I get the impression that the market will jump on any slip up in these numbers. Should we be a little bit worried going into these numbers, though, Brendan?
So one of our 3Ls a few weeks back, General GIS, they reported blowout earned numbers. Like they're reporting, they're still beating. I don't know how they do it, but they are. CAG stock has tracked GIS of late, and CAG's Conagra's performance has actually, I think, tracked GIS as well. They're still they still fall into the basket of companies with better revenues and pricing power, and that's a wonderful mix that you want if you're paying out a dividend. But they've already forecast, so Conagra's already forecasted price hikes into next year. That makes me wonder what happens if they can't raise prices, and that comes to the outlook. The stock is weak. I mean, it's like it's trending lower. Let's put it that way. So the group and traders are like, well, you know what? Maybe they can't pass on costs. Maybe their product line is not as good as General Mills and others. And maybe there's a threat to the stock here. So I would say people are a little concerned about it. I think it might track lower into the low 30s before this is all said and done with. GIS actually beat and then skyrocketed and then fell. So that to me tells me that maybe the story is running out of steam. The story that we've been running on for the past year and a half: higher revenue, higher demand, higher profit margins, price pass through. And so maybe this is all running to the end and Conagra's best days are behind it. The outlook is going to be huge for them. They're going to report probably very good numbers looking backwards. It's just that outlook. Can they still raise prices like they want to next year? And that's what it's going to come down to.
Okay, and then Thursday also is Constellation Brands, and they report pre-market. They've been dealing with a big drought in Mexico that continues to be a problem for them and has been impacting their share price. I do like the beer names, though, Brendan, as we go into this shrinking environment, but this chart doesn't instill me full of confidence, though. Brendan, what do you think of Constellation Brands?
Yeah, the chart is breaking lower, though it's barely below the 65 weeks, and the breadth is still positive. So to me, that's actually good. I think investors are now officially at the crossroads, though, on the earnings stream. Solid earnings. If they have a solid earnings report, I think they can resume the climb. It's interesting. They're actually in the beer market, which is $105 billion. It's amazing. I didn't realize how big it was. They have 16%, and they're actually growing. Modelo is one of their big brands, and I've been seeing the ads for it, but I've never had a Modelo. So anyway. They're growing share in a mature business, which is hard to do. And they're taking that growth and they're plowing it into other products. So they're buying premium brands. They're buying other things to boost the profit margins. So they're clearly still, I mean, alcohol is still rising in price from what I can tell. I go in there and I see a bottle of I don't know who owns Grey Goose, but Grey Goose has gone up decently year over year over the last few years. That's if they're growing up, other brands are going up. That's just the way it is. People are still drinking. One of the things about, if we're like going back to my 07 thought and those Marriotts and Expedias, if this is like 07, Constellation Brands did very well in 08. Like they held in, they performed well until everything gave out. this might be the stock you want to own during this point. They're probably going to report decent numbers if they continue to maintain bear sales. I think growing, they have 16% of the market. They get to 17%. That's a huge amount of money. I mean, we're talking a huge market. That's like 16 billion alone in revenue on beer. So I would just say that I think they're in a good position. The chart is a little worrisome that they're below the 65-week, but I think that might be symptomatic of the current markets. If you line that thing up against the S&P, it's outperforming. So I think that you get a dividend as well to boot. So I would just say that I think it's going to be a decent report. That's just my hunch. I think they have pricing power and revenue.
Well, I will add, like he's talking about the ads, it's obviously spending a lot more money because you see Snoop Dogg.
Yeah.
Corona, you see more Modelo ads and so forth. That all costs money, Brendan.
Yeah, it does.
Margins. Anyway.
I saw the little Snoop ad last night. He's got a little new can he was talking about last night. Made me laugh. I like Snoop. Anyway.
Another one for Thursday is Levi Strauss, and they report after the bell. We've spoken a lot about the tightening of budgets for the average consumer. So maybe those old pair of Levi's last a few more years than usual now. The share price would tell you that, and I expect that higher costs are making an impact as well. Brendan, could we see a surprise here, though?
I think the chart broke through support this past week, and that break, I think, is telling you that investors aren't expecting a good report. Nike really probably set the tone here by surprising everyone, saying that they're selling their goods at promotional prices. Anecdotal, and I realize this is probably not scientific, I guess, but BJ's has this selection of clothes, and for whatever reason, you can always find out who's selling their stuff at a discount there. Like Under Armour at one point was selling tons of stuff through there, and then their earnings were terrible. There are no jeans. The jeans that they're selling are that Berkeley and Jensen, I think, or whatever it is.
Kirkland jeans.
Sorry?
Kirkland jeans.
Oh, okay. Is that what?
I'm joking. I don't know.
I don't know. I haven't either. I just say that Levi's is not there, and there weren't many jeans for sale either. So I wonder if this is an indication that they're not having the same trouble that Nike's having. They have also a history of beating estimates, and they're rather consistent at it. I wonder if Nike was a one-off, and I wonder if they tattooed the stock for no reason. I'm inclined to think, though, the outlook will not be great. I still think costs are costs, supply chains are supply chains, and the consumer is slowing. Margins, I think, will be worse than people believe. I think they probably do have a promotional end of this. However, and one thing is the short interest on this name, I think, is up around 10%. If I'm not mistaken, I may be wrong on that one. This could be live. If they were to say we're not as bad as Nike, that could rotate the chart the other way. So the first thing I thought about this stock when I saw the chart break was Ford, and I haven't been able to get Ford right one way or the other over the last several months. So I wonder if this is Ford, another one. I'd just be wary if I was short this name. I know it looks like it's breaking lower and it wants to go down to that 12 level, but is this stock Nike? I don't know. Nike might have bigger issues from China. I don't know what Levi's exposure is to China, and that could be a factor as well.
Okay, and the last one we're looking at is Helen of Troy. They report Wednesday pre-market, and they've been having a rough year with shares down nearly 60% for the year and almost 20% in September. I get it. Another company is impacted by consumers pulling back on their spending. Are the bad numbers factored in here, though, Brendan?
This stock's actually all the way back to 2018 levels. I mean, finding information on Helen of Troy is really hard. It's like the Greek god. It's like you got to go find the gods to get information. Just kidding. Stupid joke. Yeah. But the stock it's been falling. It's been falling with its earnings estimates. And I think the analyst community got it really wrong this summer, which is why that stock has cascaded from 180 all the way down to 96. Earnings estimates came way down. If you were to look at Bloomberg's charts, it actually lines up the earnings estimates. So could this be the end of the selling? Short interest is actually drying up as this thing falls. I know it has a 7-day cover on it, so it must not have a lot of shares outstanding. 7 days of cover versus only, I think, a 6%, or it's even less, I think, short interest. It tells me that I think people are moving on to other names instead of shorting this thing. I also wonder if their beauty division actually performs better than people believe. I don't know what Ulta has done of late. Did Ulta do? I can't remember what Ulta done. I should have looked that up. But I wonder if beauty actually performs better for it. You have a lot of people going back to work, going to offices that require kids going back to school. They run a lot of products that require. I mean, my house has. I don't know. It's got Helen of Troy stuff. I don't even know what half their names that they own. But this stock might be at support. It also falls into the small cap area. It's fallen so much that it's become a small cap. I mean, it's down to $2 billion in value, which doesn't really make it a small cap traditionally, but it is compared to a lot of the other names in this market. That might actually put it in the small cap value. It's only trading at growth now as well. It might be a buy down here. I think the short interest is drying up. The story can't get much worse. Everybody knows the consumer is weak. And I wonder if the beauty division surprises to the upside, which gives it a boost. It's just a thought. 7.6 days to cover it on a short interest, though, means they don't have a lot of shares outstanding.
Yeah, 24 million.
Yeah, it made it an easy short. It could make it an easy turn as well, with short interest drying up. I think a lot of people see the risk to the upside, or it's starting to develop. So I don't really know a lot about the company otherwise, but I can just tell you small cap value is one sector we like this year. It's been, I think, the best sector, or one of the best. These guys sort of fall into it. They're trading at 1 times growth at like 9 times earnings. And they had their earnings really dramatically drop this summer. So there might be an opportunity to go the other way. They might surprise.
Yeah, I'm just having a look at Ulta. It's down like 10, 12% in September. It's still holding in, still solid performance this year. But the one name I thought of, which we talked a while ago about, is Williams-Sonoma, which is a good comparison here too. And that's had a decent sell-off from different levels, but it has nowhere near the sell-off in comparison to Helen of Troy.
Yeah, Helen. It's not often you find a stock go back to 2018 levels.
Yeah,
which makes it truly oversold.
All right, listen, we are well over time, so let's get into like it, love it, leave it. Everyone knows the drill. We've got 6 names for you. This week will probably be about 15-second rundown for Brendan. But all names have got things happening this week. Let's start with Rivian. They're expecting sales and deliveries report today.
Like it. Holding above support of 32, though. Tesla's miss may be a factor. Stock seems dead, though. I'm not sure why. Need to get over 35 to get momentum going again. But I like it.
Stock is up pre-market. Duke Energy, virtual investor event.
I would leave it. Lost the 65-week last week in dramatic fashion. Broke good support at 96 and breadth turned lower.
Costco, we referred to just before there. They got a sales update on Wednesday.
I liked it 2 weeks ago. It failed. I would leave it now. Take that with a grain of salt. Broke through support at the 65-week last week and it did not reclaim it. Breadth is still positive, so you could find some buyers, but I would leave it for now.
Illumina, I love this coming. I think I've got some great things. They've got an investor day today, which I'm interested in watching.
I like it. Found support around 190, but it also rejected the 20-week, but it's at support, so it needs to reclaim that level to keep the sales short, keep the shorts away. But I like it.
Google/Alphabet, they had their Pixel hardware event on Wednesday.
I would leave it. It has a pretty sizable range below to fill to go lower. Breadth is weak. The saving grace for the bulls is it's oversold as much as 2008. So Google's been really hammered, and that could make it susceptible to the other side, but I'd leave it.
And the last one, LW, Lamb Weston, they're reporting on Wednesday pre-market.
So I didn't realize what these guys made were tater tots and stuff.
Oh, yeah, you've had them.
I love those things. Oh, my God. Love tater tots. And I like it, actually. It's kind of stalled out of nowhere, and it did not hit the resistance at 84, which usually when a stock rallies, it hits a resistance and falls. It just stalled. I don't know what this has to do with potato prices, maybe, but I like it. I think it gets to 84. I think that's where I think it runs.
Fantastic. Well, as I said, we've gone a little bit 5 minutes overtime today. Brendan, thank you very much for your help this week. Always great to hear your thoughts. You have a great week.
You too. Take it easy.
And for everyone else out there, good luck investing.